I'm Eileen Yuen, the Managing Director for the Financial Institutions Practice here at Gallagher. And I'm joined today by John Marchisi, our National Director for the SPAC segment within our practice group. Thanks for joining me today, John.
Thank you, Eileen. Thank you for having me.
Sure. So today we're going to talk about SPACs. We've seen a lot of press around SPACs. Obviously, high inflation, rising interest rates, the uncertainty of a recession has all come into play in the IPO and SPAC market. Can you describe for us, John, what are you seeing from a current market condition standpoint in the insurance market for SPACs?
It's a good question, Eileen. As you noted, there's much fanfare. There's been much fanfare around the SPAC marketplace for the last 2 years. I think I would answer that by getting back to the basics, right? So the SPAC, although it's a bifurcated IPO process, and that's somewhat well known at this point, it's also a bifurcated capital raising process, which I think is one of the key elements that has been a result of an earlier iteration that led to the current influx of investors into the marketplace itself, the level of deal flow that's come into the marketplace, but there hasn't really been an appreciation on the other sides of the market that have been dealing with SPACs, that there's this capital raising function that has to happen at the time of the de-SPAC that is now in the DNA of the SPAC ever since the vote and the redemption right were decoupled. So you have, if you think about the current market condition, the original IPO raise consists of absolute strategists. The typical return profile there mimics a cushion bond rate of return to, say, 3% for funds held in trust, which is honestly riskless arbitrage. And they do that for the benefit and the optionality that are provided to them via the warrant. So you have that initial IPO investor base that stays in from inception of the IPO through either the closing of the business combination or dissolution. At the time of the de-SPAC, the trust account needs to be recirculated because most often those investors in the original stage, the absolute strategists, are going to redeem, they're going to hold on to warrants, and then that cash needs to be recirculated to a new investor base. You can shore up those commitments with various different features that have been introduced to the SPAC: forward purchase agreements, backstop, anchor investors, but most commonly raising a concurrent pipe at the time of the combination. So if you think about when the SPAC was successful, and I go back, I share a slide, I think I shared it during the RIMS presentation. I correlated the SPAC's success and the ebb and flow of its success through, say, 2004 to current day with certainty. And I use that word certainty because it means various different things in a SPAC context. So it means the certainty of capital. The earliest iterations, there was vote arbitrage where good deals were getting scuttled for a return on the short side of warrants. There's been features in the SPAC that have been introduced to do away with that. That was another feature that led to the success that we've seen recently. And then you see things like the certainty of that capital being there for the recirculation, for the de-SPAC, certainty of risk, right? The regulators are looking for certainty about the robustness of the disclosures, about mitigating potential conflicts of interest, all of those things. So we're getting into an environment, as you mentioned, with inflation, with the broader capital markets environment, that is leading again to an environment of uncertainty, which is where the SPAC really struggles. So coming from the institutional investor side, I was a former analyst and institutional investor in the SPAC market back from 2004 to 2010. So in thinking about deploying institutional capital into a cushion bond rate of return, where we are currently with market valuation, where we have the S&P rebalancing now, we're down 20%, that's going to be a difficult task for new IPO issuance in the SPAC market. So people say that that the broader IPO market might not be necessarily shut down, but when you think about the different context of a SPAC IPO versus in that initial investment and the return on that investment and the potential opportunity cost that you would lose being in an absolute strategy for 18 to 24 months, perhaps longer, it's quite different when you compare that to a traditional IPO. So On the second side of the market, if you will, so the backside of the transaction, the de-SPACing transaction, now you have to bring in, as I mentioned, additional investors that are now fundamental investors, right? So the due diligence that they do in that market is orders of magnitude greater than an event-driven absolute strategist. So now you're bringing in an additional investor base to credentialize the deal, to raise capital, and that's where some teams are struggling. They're struggling with the quality of the target. They're struggling with the ability to raise capital. So I think it's been well discussed. It's no secret now that SPACs are coming to a wall of the end of their tenors, right? In their maturity at their original 18 to 24 months. That is something now that they're seeking on our side for D&O. They're seeking extensions that were granted for them via their charter originally in the S1, or now they're voting to extend. So that's something that we have to manage on our side. Again, that creates an additional capital raise or need for additional operating capital held outside trust, which is one of the reasons why SPACs are choosing to liquidate. So there's a lot of talk in the media about the difficulty in finding a quality target. That is a significant issue, but that's one of only, say, 4 reasons for liquidation, 3 of which are focused on capital. Either teams are finding that they don't have enough capital to complete their diligence process, operating capital on that side. They're finding that they don't have additional capital, or they don't have the ability to raise additional capital to sweeten the trust for dealing with extensions and raising money for additional months to complete either a combination or to locate a target. And lastly, to meet minimum cash conditions. So meeting minimum cash conditions is a critical element of this process. And it really went unnoticed until late. That's how we initially underwrote the deals in our underwriting process. I was focusing 18 to 24 months into the future, looking at macro factors, looking at my team's ability to recirculate cash, whether it be a following of long-short investors, whether it be just be loyalty of investors that were going to credentialize and finance a deal for them. And that was just a critical element that now we're seeing come to play. And we're seeing less healed teams and teams with less access to deep pools of capital and quality investors that are going to follow them, and their decision-making going forward are really going to struggle.
Okay. Thanks, John, for that really great overview. So if we take all that into account, tell me about how that is influencing the work that we're doing for our clients in this space.
So going back to the white paper, right, that was written in 2007, I titled the white paper A Strategic Perspective because I recognized how strategy was going to play into this process for our teams, right? So insurance is coming in as an asset in the transaction if the team uses it correctly, right? So you have solutions that have been developed out there in the marketplace. You've heard them come and they've gone by the wayside. Somewhat gimmicks, somewhat things that couldn't sustain, right? That were materially deficient. Whereas our teams are positioned now strategically in a SPAC off against other teams that they're competing with. And those programs are being contemplated with the team and their proposed transaction. So we're continuing to support that transaction in negotiating extension periods, which is honestly a non-event. You see a lot of fanfare and doom and gloom about the availability of extensions. Our insurers, even the ones that are no longer active in the marketplace, are supporting those transactions. Extension periods are available. There is some rate normalization from the very early deals. But then secondly, we have teams that are coming to us that were written in a materially deficient way. Either they didn't have a tail that was pre-negotiated, they had onerous terms, they have issues with the sponsor and how that's going to play into the coverage. And then lastly, we have teams that are coming to us now that are purchasing vehicles. So there are vehicles out there with, say, 9 months, 10 months, 12 months left on the original tenor. They're selling that vehicle to another SPAC team to then go out and complete the process, right? So when those deals come to us, and they've come to us on both sides of the market, which then my advisory varies drastically, because it's who am I actually advising? Am I advising the legacy team? Am I advising the acquiring team? Am I on both sides? And so there's a lot of advisory there, and that's something that we did first in the marketplace, of vehicle getting sold. And so, you're initially going in, you're contemplating how the incumbent program addresses change in control provisions, and then where the limits are, and if there's going to be a potential impairment, and how to optimize that going forward. So I would say it's not impacting our teams on the insurance side. The capital market side is what they're dealing with. We're supporting that through insurance and through insurance due diligence, so we can support the transaction. But we are trying to optimize their premium experience and take all of the volatility that's associated with extension periods and potential de-SPACing out of their process for them.
Yeah, that makes sense. Thank you. Now the $1 million question. I know none of us has a crystal ball, but what are your thoughts on what the next 12 months looks like for the SPAC market?
I'm very positive on the D&O side, right? So again, a lot of doom and gloom in the past 12, 18 months. It's proven not necessarily to be the case. When you look, SPACs are performing alongside the broader market on just a stock performance basis. But when we talk about claims, we obviously manage a significant amount of claims and high profile claims, and we're seeing them develop in ways that don't meet the initial expectations of the market, right? So the market's come off. For a SPAC coming out now recently, is the market's off 30% from the highs. The de-SPACing marketplace is also starting to soften. I think the insurers are now able to quantify more so than in the past, as these claim scenarios and various allocation issues that came to be at the time of the combination, they're starting to quantify this as these things develop and mature. So data is their friend. These settlements are their friend, and it's helping the marketplace. The capacity side, I think it's more of a need to deploy, because the significant D&O marketplace has dried up with over 900 IPOs last year. So they have a need to deploy capital. So I think that's going to be something that ramps up into the end of this year. We might see a little bit of a pullback, but again, the way that we're presenting these risks to the marketplace, they're being accepted and they're being optimized and they're favorable. Insurers are not running away from good deals in this market.
Great.
So additionally, Eileen, we're doing work across the broader financial institution book of business that we have with our current clients in the private equity space, the venture capital space. 30% of these targets are private equity backed assets. So with that said, they perform demonstrably better. And the data is there to show that. That was part of our original underwriting model and really a core of what we look to sort out to assist with. So on that side, I think we're going to continue to see a maturation of these private company targets, not only on our side, but on all advisors. They're readying their financials. They're readying their cybersecurity posture, their IR apparatus, all of these things to prepare themselves to be able to function as a sustainable public company. So I think that's going to continue to be at the forefront of the work that we do to support that business. So we're actually supporting on both sides of the transaction, if you will.
Yeah, that's a great point and makes a lot of sense, John. Thanks for joining me today and giving us your insights. And for everyone out there, if you have any questions or would like to learn more about what Gallagher's doing in our work with SPACs and the IPO market, please feel free to reach out to John or myself directly. Thank you.